Hey, MCE crew, recently I got rid of my family savings accounts, got rid of them, okay? And you may have heard me talk on the channel before about how the savings account was a component of your opportunity fund. Well, I've changed my mind on that. I'm going to tell you what my rationale is. And, I'm not saying that you should do this, but I'm going to tell you why I did it. Now, before I get into that, I do have a couple of little news items I need to bring up to you. Of course, I need you to like and subscribe, please. For those of you who have, thank you so much for doing that. Share this because we're trying to spread this message. Today, if people don't pay attention to their money, they're going to be in for a rough time in the years to come. They're going to be a part of the dependent class, okay? And the dependent class, of course, is the government. They'll be taking care of you. And we're already seeing that if you don't do what the government wants you to do, then they will come in and they will disrupt your ability to put food on your table. So you've got to be financially independent. And so we want to spread this message. Okay, so help me out with that. The other thing is this. I'm not going to be making any more Friday videos for now. We're going to have a Monday through Thursday video, and then on Saturdays we're going to have the documentary videos, which are the longer format stuff that is on the channel now. We're going to have more of that. The reason we're not going to do a Friday video is simply because when I look at the analytics, it really doesn't get the traction that I'd like it to get. Now, we're a small channel, of course, we're trying to grow. But I feel as though this information is so important that I want as many people as possible to see it. So therefore, if Friday's not a good day right now, I'm not going to put content out on Friday. But we'll still have the same amount of content, just over a different time span. The last thing I want to bring up to you before we get into why I dropped those savings accounts, the last thing I want to bring up to you is this. You'll often find that people in the financial services industry, for whatever reason, they love the subject of quantum physics. I'm no different. I always have loved the subject of finance and physics, okay? Couldn't tell you the first thing about biology. I'm not a real big fan of chemistry, but physics, especially quantum physics, that is my area. I love it. It is definitely something that if I wasn't doing financial services, I might be a scientist. Who knows? But scientists really don't make a lot of money, so I probably wouldn't be. But anyway, I want you to know that I'm pursuing that passion in a different way. I have started another YouTube channel. And the reason I did that is because my wife encouraged me she's been encouraging me for a long time to immortalize my scientific theories, okay, to talk about it. So listen, if you don't have an interest in that, definitely don't waste your time. But if you do, if you like physics, if you like the subject of what the nature of reality is, things like that, philosophy as it intersects with physics, then I want you to subscribe to the Quantum Closet. I'll leave a link in the description. Now, you might go over there right now and say, what's going on? This guy has no videos. Right. We're not putting any videos on that channel until we get 100 subscribers. Okay. I've learned a thing or two about YouTube since I've been doing this, thanks to you all. So if you like that type of subject matter, or you know someone who does, go ahead and subscribe to the Quantum Closet on YouTube, where I talk about physics, philosophy, reality, alternate realities, all of that kind of quantum physical and theoretical physics stuff. Okay, so let's jump right into it. Why did I get rid of the savings accounts? Quite simply, they weren't making any money. In fact, having money in the savings account is now a losing money proposition. Warren Buffett always says that what we should do is pay attention to his 2 rules of money. The first rule is don't lose money. The second rule is don't forget rule number 1. Now, I had an online savings account with Marcus, which is Goldman Sachs's, whole deal. But they were giving out only 0.5% in interest. Now, that's actually more than most brick and mortar, than all of the brick and mortar banks that I've seen, okay? We've talked about this before, how those brick and mortar banks, they got to pay for the rent, the snow removal, security. They got to pay gas and electric for the building and insurance and on and on and on. But these online banks don't have that type of overhead, so they can afford to give you a few more percentage points on the, or in this case, fractions of a percentage point on the interest that you earn from your account. But at 0.5%, and we've been experiencing inflation at over 5%, that's obviously a losing equation by about 4.5%. The money's losing value sitting in a savings account. So I thought long and hard about it and tried to figure out where I wanted to put that emergency money. And one of the things, and I explained this on the channel previously, that with the online banks, it usually takes you a couple of days to get the money in your account. Okay, it's not an instantaneous thing like maybe if you ran down to the ATM machine. But that's okay, because that also has the benefit of saving you from making impulse purchases with the money if you're getting your discipline up. So taking that into account, I said, you know what I'm going to do? I'm going to put this money into what's called a municipal bond ETF, or exchange traded fund. Municipal bonds are basically those types of bonds that are issued by counties and cities. And they issue those bonds in order to do various work that needs to be done in the city. And they pay, an interest rate or a yield on those bonds. And that's how folk make money off of that. And typically, the municipalities are fairly stable. So it's not like you're going to get 10% out of that, but you're not going to get 0.5% either. Let me just talk about briefly the ETF that I went ahead and put that money in. I'll just give you some info on the return, the rate of return that it has seen historically. Now, it is more, it is a bit more risky than keeping in a savings account. And the reason for that is because the savings account guarantees an interest rate. They'll tell you what it is. In the case of Marcus with Goldman Sachs, it was 0.5%. So when you invest in a anything on the market, this ETF, for example, then you take on more risk. So doing the Muni ETF has given me the ability to make a higher rate of return on that money, but at the same time, it is much more volatile than the savings account, of course. And within that volatility, there's an opportunity to get a higher interest rate. Now, that money, I want to make something clear to you. That money's just sitting there as, for an emergency. Okay, it's not designed to be growing at some phenomenal rate in order to address retirement or a new home or anything like that. Okay, its job, and we wanted to get that money working harder, so its job is to not lose anything, but to kind of keep pace with inflation. Now, it's a long-term play. It's not something that, I would hope that emergencies don't happen very often to the tune where I would need to, access that, where my family would need to access that. So if you look at the 5-year return on this, it's 3.47% over 5 years. And you might say, well, you just said inflation was running at over 5%, and that is true. However, if you look at inflation on the long term, once you start to stretch it out year over year, then you're in the neighborhood of somewhere 2.5%. Okay, so at 3.47% over 5 years, you'd be in front of inflation, and then you'd still be a percentage point and change over and above what they're giving out at the banks in terms of the interest rate on the savings account. The other thing you got to remember with banks is this, and look, I'm not knocking their hustle. A lot of people do that with the banks. I'm not going to do that because banks serve a purpose. And as long as you know what the purpose is, then you can navigate accordingly. So banks, what that bank was doing, it was taking the money that we had deposited in there, and then it was using that fractional reserve banking system where, for let's say, for example, for every $100 they have on deposit, the government allows them to loan out 10 times that. So for every $100 I had in there, they were able to loan out $1,000. They're doing that, but they're certainly not charging people 0.5% interest on car, credit card, or mortgage loans. That would be senseless because they do have to make money. Okay, it is a for-profit venture. But it just I didn't want to play that game anymore because I wasn't getting anything out of it. It's so one-sided because of these interest rates. And some people might say, well, what about the FDIC and all that? Well, I can't remember the last time that, John Dillinger broke into the bank and stole all the money, and it impacted people personally. The FDIC certainly is something that can help keep your money safe up to a certain point. But what you also have to remember is the FDIC works on actuarial tables, which means if your bank suddenly folds up and you lose, let's say, $10,000, well, the FDIC is not going to cut you a check the next day. They're actually going to look at all of the people that had deposits in that institution, and they're going to go through that based on age. And the younger you are, the further the back of the line you will be. That's not an instantaneous process. So the FDIC it's a nice sticker to have on the door for people who don't know any better, but it's not, something that is even used. That protection is not used that often, and when it is not an instantaneous process. So that's why I ended those savings accounts, and that is what we did with the money. Put it in the muni bond fund. So if I do something additional with it, or if I start to put other emergency savings into other places, I certainly will let you guys know. Remember, do your own due diligence. Don't rely on me because my situation is different than yours. I'm just putting out ideas. All right, guys, I'll talk to you soon.